Hi everybody, this is Ellman, the blue collar investor, with today's option selling question of the day. Today's question comes from Jim. Alan, can one wait too long when in-the-money options go too deep in the money? On 1/5/21, I bought RIOT, that's ticker RIOT, for $17.14 and sold the February 19th $14 call for $5.65. On February 15th, the stock was at 48.06. Wow. Should I have rolled up sooner as the stock was gaining value? Thank you, and it's signed Jim. Okay, well, one of the things implicit in Jim's question involves position management. How do we manage trades when the price of the stock goes to the moon very quickly, as it did with RIOT? So let's start off by having a look at the price chart of RIOT in that time frame so we can get a feel for what actually was going on. Now in the screenshot, you see on the top by number 1 that the exponential moving averages were quite bullish. They were ascending. The shorter term 20-day EMA blue line was higher than the longer term 100-day exponential moving average, the red line. The price bars were at or above the 20-day exponential moving average, very bullish. Now number 2, the MACD histogram was also bullish, where you could see those blue bars ascending and above zero. The stochastic oscillator, a momentum indicator like MACD histogram, was also ascending. Actually, it was in an overbought position above the 80th percentile, having moved from the 20th up to and above the 80th, but I've seen stocks stay in the overbought position for months at a time, so I would consider this a quite bullish parameter as well. And finally, number 4, all of these bullish indicators took place with high and strong volume, making them more meaningful. So all in all, from a technical perspective, I could see why Jim selected RIOT as one of his underlying securities. Now let's have a look at Jim's trade here. On 1/5, Jim purchased RIOT for $17.14 and then sold the 2/19 about 45 days out, 14 in the money call, lower than current market value, for $5.65. And then on 2/15, a few days before expiration, RIOT was trading at 48.06. Wow, it almost tripled in value in those days, in the days between the purchase and when Jim sent me this email. Now let's calculate the initial returns the way Jim structured this covered call writing trade. And if we use the multiple tab of the Ellman calculator, keeping in mind that these are 45-day returns, we could see that the ROE, or return on our option, that's time value only, because the calculator will deduct the 314 of intrinsic value from that 565 premium and give us our real initial time value return of 17.9%. Now that's for a 45-day time frame. Now because Jim sold an in-the-money strike, there is no upside potential, which is what happened. The stock went to the moon, but Jim couldn't take advantage of that because he sold an in-the-money strike, and that is the disadvantage of an in-the-money strike. The advantage is that you have downside protection. Should the price of RIOT gone the other way, Jim would have had 18.3% downside protection of that 17.9% initial time value return. So stated differently, Jim would be guaranteed a 17.9% 45-day return as long as RIOT didn't drop from 17.14 to below that 14 in the money strike. So what can we take away from these calculations? Because having an understanding of how options work is going to make us very successful option traders. So when we look at these calculations, what does it tell us? Well, we have a 17.9% time value return. That annualizes out to 145%. Well, to get these huge returns, that means the underlying security must have a very high implied volatility. That means the market is expecting huge price movement in the security, and it doesn't give direction. It just says huge price movement. So that means that there is risk to the downside. In this case, RIOT went up, could have gone down. Okay, so there is risk to those trades. And when we set up or establish our covered call writing trades, we must make sure that the securities we use align with our personal risk tolerance. For me, this would have been too risky of a security, but for others, it may be appropriate. One size does not fit all. Now, Jim mentioned rolling up to capture some share appreciation. So let's analyze that for a second. If you roll up, you may have an opportunity to capture additional time value premium when you roll the option. But you must pay intrinsic value to capture that time value premium. In other words, you're going to have to add more money to the trade. Now remember that this was a trade that the price of the stock went up a huge amount in a short period of time. So that means that there could be some profit taking. And if there is, the price of the stock is going to go down. So can we count on that stock to continue its appreciation that would justify rolling up? Now, if we rolled up to an out-of-the-money strike, in addition to time value on the option side, we would have an opportunity to capture additional share appreciation from current market value up to that out-of-the-money strike. However, we're counting on this stock that appreciated dramatically in a short period of time to continue its move up. Is that realistic, or is that something that is in our favor to do? Well, as you could tell from my demeanor here, I think there's something better that we could do. And those of you who've been with the BCI community and read my books and watched my online video courses know that when the price of the stock goes up dramatically, leaving the strike deep in the money, the mid-contract unwind exit strategy, or MCU exit strategy, is what we look for. And you could use the Unwind Now tab in the Elite and Elite Plus calculators to get these statistics. And what we want to do is determine the time value cost to close, not the entire cost to close, because the intrinsic value is going to be huge, but that's going to be negated by the increase in share value from the previous strike price, and then closing that out, so the stock will be worth current market value. So we want to know the time value cost to close. And as that approaches zero, which it will when the strike moves deep in the money, then we ask ourselves this question. If we close both legs of this trade, can we generate at least 1% more than the time value cost to close that would then influence us to consider the mid-contract unwind exit strategy? And that is where I would find myself as it relates to position management with this trade. Let's summarize. The implied volatility of our underlying securities must align with our personal risk tolerance. For me, I look for an initial time value return goal range for 1 month near the money strikes of 2 to 4%. I'll go as high as 6% in a strong bull market, but never higher. That is right for me. Doesn't necessarily mean that it's right for you. Now, when a strike moves deep in the money, the strategy we look at is the mid-contract unwind exit strategy. And we want to make sure that we can get in a new trade at least 1% more than that time value cost to close. Rolling up in the same contract month has some inherent risk, profit taking. Now, as expiration Friday approaches, which is in a couple of days from when I received this email from Jim, we can consider rolling out or rolling out and up, and for that we use the What Now tab of the BCI calculators to see if those calculations meet our stated initial time value return goal range. Okay, before I go, folks, I just want to remind you that if you're a premium member, only premium members have access to the entire library of Ask Alan videos, now 188. Just log into the member site, scroll down on the left side, and then click on the Ask Alan video that you're interested in. On the right side, we have the titles of the videos in the resource download section. We do make these videos available for 30 days for the general public, and then they're archived for permanent use only on the member site. I also want to bring to your attention a new BCI package that we created at the beginning of 2021. We call it the BCI package, which is an acronym for our best and most comprehensive educational package ever offered by the blue-collar investor. And it includes 6 online video courses, 6 calculators created by the blue-collar investor for option selling, 5 of our best-selling books in ebook format, and our 13-month annual premium membership, which has too many perks for me to mention in this video. So that's available at a 20% discount. Just go to the bluecollarinvestor.com website and look for that BCI package link, and there's a video there with a further explanation of all the benefits and the discount, leaving a price of $9.97 for all the items that I just mentioned. So check that out. So ladies and gentlemen, once again, I want to thank you all for taking the time to listen to this Ask Alan video. And of course, I want to thank Jim for sharing with us his trade and for asking a question that gave me the opportunity to share this information with the entire BCI community. So thanks to one and all. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.